Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. 2022 has been brutal for mortgage rates. This past week has been the worst so far, with the average lender increasing their rate by 25 basis points or a quarter of a point. This puts the average conforming 30-year fixed rate as high as it's been since November 2008. This past week has been one of the worst weeks for mortgage rates since 2009. If the line in the previous chart looks a little steep, that's because with barely half of 2022 in the books, it has been the worst year for rates since 1979. As I said in last week's video, it's all about the ugly I word right now, inflation. There are many ways to measure it, but if markets could only choose one inflation report to rule them all, it would be the Monthly Consumer Price Index, or CPI. The following chart shows overall CPI, including food and fuel, and core CPI, which excludes food and fuel. Both CPI readings were higher than the markets were expecting. Stocks didn't like the news, and neither did bonds. Markets were getting used to inflation showing a sideways trend or a possible leveling off, and this resulted in rates having several solid weeks in May, as inflation is a key driver of interest rates. Rates couldn't ignore that European inflation set a record on May 31st. Now, to be fair, the trend was actually fairly linear over the past 2 weeks before Friday took things to the next level. Two-year treasuries had it even worse than the 10-year. The most basic rate of all is the Fed funds rate set by the Federal Reserve. It applies to the shortest term loans with timeframes less than 1 day, sometimes referred to as the overnight rate. Because the two-year treasury is a shorter term and is much closer to the Fed funds rate than the 10-year treasury, twos feel it more when the Fed funds rate expectations change. And expectations are changing. There are metrics that track the market's expectation for the Fed funds rate. They are called Fed funds futures. These metrics began to level off in May as hopes of inflation were also leveling off. Then came the inflation report, and Friday saw some of the biggest single-day movements in the Fed funds futures, with an entire quarter of a point change in a matter of just hours. The lifespan of a mortgage is less than 10 years. That means that people either sell or refinance within 10 years of the start of the previous mortgage note. Lifespan expectations for mortgages are especially short right now because we expect to see rates move down enough to motivate refinance demand at some point in the next few years, maybe even months. Because of this expectation, mortgage rates are behaving like bonds that are closer to the Fed funds rate than 10-year treasuries. Not to mention the less friendly stance from the Fed on its mortgage holdings. Among other factors, this creates the perfect storm for volatility in 2022. With all that I've said before and in previous videos, there was something about this past Friday, an X factor, if you will. That X factor is this week's Fed's meeting. The Fed will be out at 2 p.m. Eastern on Wednesday afternoon with its latest policy announcement. Now, I'm not saying the Fed will hike rates higher than expected at 0.5%. I'm saying that markets are interested to see what the Fed has to say about future path of rate hikes. Now, keep in mind, the Fed announced at the last meeting that they didn't see the need to hike rates by more than 0.5% and that 3/4 of a rate hike was off the table. Wednesday's meeting will be important because it is one of the 4 meetings per year where the Fed also releases updates, economic projections, or a look into the future. With CPI coming in hot this past week, markets can't help to think that the Fed may have to retract its previous comments and get a bit more aggressive. So to put it in perspective, last Friday's surge is the market's way of getting itself ahead of the curve or anticipating what the Fed may do. What is still to come is the announcement of the Fed of exactly when they may run off some of its mortgage holdings. They've promised that that's a ways off and that they give ample warning. But big surges in inflation could move that warning higher on the Fed's to-do list. Yes, in fact, there's quite a lot of hope, and I must apologize if this video seems like doom and gloom, but I must keep the videos honest. This month's CPI was bad for sure, but inflation is definitely taking a toll on the demand side of the economy right now. Rates have also risen so quickly that there's a case to be made for a correction. I don't see that our economy can sustain a high rate of inflation over a long period of time. All that would be necessary to spark a correction in mortgage rates would be for inflation to just calm down. Once that happens, rates will only have 2 options, either sideways or lower. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.